Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Our goal with the podcast is to sit down with top market practitioners, educators, authors, technical analysts, market strategists, money managers, investors, traders, anyone else I can get a microphone in front of, and hopefully ask some thoughtful questions to unpack some of their lessons learned over their careers, to hear about what they're seeing and thinking about the current market environment, what lessons they've learned over their career and how they can apply them to the current market environment, and all sorts of other great stories. And today, really fun interview with Tom McClellan. Everyone loves a good origin story, and this is an origin story about one of the technical indicators that many of us take for granted. Pretty much every technical analysis platform that I've used has the McClellan Oscillator programmed somewhere in there. And we're going to learn from Tom McClellan the origin story of the McClellan Oscillator. We'll learn about his parents, Sherman and Marion McClellan, in the Southern California, and designing this indicator, how it was actually promoted through a local access television in the Southern California, and then how it proliferated from there. But really, we're going to talk about market breadth and conditions. We'll talk about how the McClellan Oscillator really just represents market breadth conditions and how they change. It's really based on the slope of the advanced decline data, and Tom will share with you why that's important and how he has used it for decades to understand the markets and really make some impressive calls about market conditions. We'll talk about why pilots might make great investors and great technical analysts, and musicians as well. Tom offered up, which I was pretty excited to hear. And we finished up with some really an interesting analog comparing 2022 to 2025 to another period in market history where there was a new president coming in, where there are a lot of expectations about a lot of changes that would be pro-business and address inflationary issues. And you'll see that the beginning actually ended up being pretty rocky. So I thought Tom had some really interesting, an interesting analog to share and some interesting comments about looking at a new Trump presidency, or I guess the second Trump presidency, compared to another presidential change that we had a number of years ago. So please enjoy this conversation, I'm sure you will, with Tom McClellan, editor of the McClellan Market Report. Hey everyone, super excited to be sitting down today with Tom McClellan. Tom's a longtime editor of the McClellan Market Report, a fellow Pacific Northwesterner. And Tom, good to see you again. Thanks for coming on the show.
Yeah, although in December we like to call it the Pacific Northwet.
That's absolutely right, and I think very poetically and appropriately, it's a little wet outside as we have this conversation. So situation normal here in the Seattle area.
Well, listen, the thing you need to know about, if you're ever contemplating coming here, the rainy season typically begins October 1st, and it usually ends September 30th. So you want to work around that.
So time your visit appropriately, right?
Yeah.
You and I people should know some of my favorite jokes about the Seattle weather have come from you on my original visits to this area, and I'm ever thankful for that, Tom, making light of this beautiful place that I think we both have fallen in love with at different times, in different ways. So I'm super excited to share some of your thoughts with our audience, talking about the McClellan Oscillator, which I know many people associate you and your family with, and just thinking about the market conditions. Obviously, sort of an uncertain, uncomfortable time. I feel like after an incredibly strong year, so I know a lot of people are sort of wondering where you're at. You shared some charts with us that I'd love to start with, and one of them, is really just talking about the conditions recently. I mean, the reality is we're just coming off of new all-time highs for the S&P and the NASDAQ. As you sort of assess the conditions here, thinking about breadth, what's your general sense?
Well, and that's the question you got to ask yourself every day. Is the world about to end? Is the sky really falling? Are we all going to die? Or is this an oversold opportunity in an uptrend? And it's probably more like an oversold opportunity in an uptrend. But I have grave worries about next year. But we're not into next year yet. We have an oversold opportunity to play.
Yeah. It's interesting when we're looking at the breadth conditions. One of the things you and I were talking about before we got started was just the conditions of the breadth, and there was a potential divergence that was forming, but then sort of went away here. Can you talk us through this chart and just what it tells you about the conditions now going forward?
Yeah, and this is one of the primary tools we use is the New York Stock Exchange Advanced Decline Line. And so it's a cumulative running total of the daily difference between advances and declines. So every day it changes according to what we call the daily breadth, meaning advances minus declines. And so if you have more stocks going up today, then the AD line will go higher. If you have more stocks going down, it'll go downward. And generally, most of the time, the advanced decline line will do whatever prices are doing, and that's normal. It gets interesting and useful when they start doing something differently. Back at the end of 2021, at the left end of that chart, we had a genuine divergence, and we talked about that a lot in our newsletter. Like, oh, this is bad. This is really bad. When you have a divergence like that, when the AD line is acting a lot weaker than prices, that's really bad because it says that liquidity has left the building. The market can have lots of different kinds of problems, but liquidity problems are the worst kind and the hardest ones to get out of. This year, in November, right after the election, we started to have a little divergence where the AD line was making a slightly lower high and the prices were making a higher high. That divergence got what I call rehabilitated. It got off the Group W bench, and we saw a higher high in the advanced decline line. So we have no divergence now, although we have a big honkin' owie, a big sharp drop, which can happen at any time, but we don't have a divergence yet. So we don't have that indication of a big bear market coming. We could get another one at any time, but we don't have it yet.
So we really haven't seen the divergence. I mean, and 100% agreed, right? It looked like we might be getting that, but then that renewed strength we saw going into December sort of changed with that. Now, obviously, we've had a pretty steep sell-off this week, bouncing again on Friday. It's been an incredibly volatile week after a fairly low volatility period. How do you make sense of a week like this, and how does that relate to sort of the long-term picture that you're seeing painted over time?
Steep is the key word, and it's right that you focused on the steepness of the sell-off tells us things. And what I'm talking about is the slope of the advanced decline line or the slope of the market. If you took your ruler, took it out of your desk drawer and laid it on the chart and said, what is the slope of the advanced decline line? You would have your ruler pointing down really steeply. Well, when you measure that mathematically, you can get some useful insights and say, oh my gosh, it's been steep for a while. And that has important meanings about what comes next. And that really ties into what the indicator my parents developed, the McClellan Oscillator. It's a measurement of what is the slope of the advanced decline line. You might say that in mathematical terms, the McClellan Oscillator functions as a second derivative of the advanced decline line. The slope of the slope of the slope. How fast is the slope changing?
I would love to. So you brought some slides with you, really breaking down the mechanics of the McClellan Oscillator.
Yeah.
I'd love if you wouldn't mind, because I know so many people I think are familiar with this indicator. We hear it referenced a lot. I think you better than anyone can help explain the methodology and just why it makes sense to track this. So here's one. Let's start here and please take it away.
Well, and understanding this is a little bit important because you got to know what you're looking at. A lot of people say, don't tell me how to build a clock. I just want to know what time it is. But really, you got to understand this a little bit. On the top of this chart is a plot of, this is back from 2022. This is just for instructional purposes. It's a plot of the daily difference between advances and declines. And it goes all over the place. It's very noisy. Everybody's shifting one way one day, everybody's going the other way the next day. To smooth that out, what my parents started doing was something that other people had been doing in the 1960s, was to look at a smooth version of that data. They use exponential moving averages known as the 10% trend and the 5% trend. And those numbers refer to the smoothing constant, meaning how fast does the exponential moving average adjust to changes in the data. The higher the number, and as in the 10% trend, the faster it adjusts. The slower adjusting 5% trend, it takes longer. And so that red line and green line are reflective of what's happening in the daily advanced decline difference. And the key insight that my parents had back in 1969, they looked at the difference between the two moving averages, as opposed to just looking at each moving average on its own. And that difference is what we call the McClellan Oscillator. And so if you can imagine the mathematical difference between the red line and the green line, that is the McClellan Oscillator that's shown in the lower part of the chart. And so the McClellan oscillator will go up positive when you have a string of up days, meaning more advances than declines. The McClellan oscillator will go down below zero when you have a string of days that are negative, when breadth is negative. But you can get additional insights more than just the numerical value by looking at how far it goes, how energetically it goes, looking at the structure of it, looking at divergence versus prices. There's a whole lot more information than just the number.
So you don't just look at the value of the McClellan oscillator, you look at shifts in the McClellan oscillator, divergences, I would imagine, between market prices and the McClellan oscillator as well?
Of course. And if you see a very simple structure, like a little spike down and back up, a simple structure says that move was weak. When you see a complex structure where it's chopping up and down without crossing the zero, like you see at the right end of this particular chart, that complex structure says that side of the zero line is the strong side. And that strength will typically persist until you have a divergence.
Very, very interesting. So we have to, of course, consider now, what is the McClellan oscillator, in your opinion, telling us about the conditions now, particularly this week? And we covered often on our show, we've tracked how the McClellan oscillator has gone below zero. What now? Where are we at?
It went down to oversold is not quite a strong enough word. You might say hypersold. The bungee cords have been extremely stretched. And
right.
As we talk here on Friday, the 20th of December, we're getting a nice bounce back from this oversold condition. This chart is only current through the 19th of December because we haven't got the closing numbers for today. But when you get a very deep negative reading like that, you are very oversold. And the market can only do that for so long. Once you get so far down, it just can't keep the selling pressure, and you leave a vacuum behind that the market bounces back up into. Whether you get just a snapback bounce to make back a part of the losses, or whether it turns into a new uptrend, that's a different question. And you can't get that answer from just looking at how negative it is. You have to look at how the bounce unfolds. And so, that's what we'll be looking at in the next few days.
Interesting. You're reminding me where Linda Raschke, who I think we both know, talks about the rubber band being stretched to an extreme. And it feels like we're at one of those times, certainly this week, where the McClellan oscillator flipping through zero was sort of the signal for me. And all of a sudden it feels like we're at one of those extreme readings at this particular point.
Well, and about that, when you're at an extreme reading, being oversold is not a signal. It's a condition. And that condition doesn't have to adjust itself just because you noticed it, or it can stay extended for a long time. And so you're looking at a condition, and the condition is going to matter, but it'll matter when it decides to.
Yeah, the condition can remain so for longer than you probably think it should.
Right, usually right up until you give up on it mattering, and that's when it starts. That's when it starts to matter.
It's true. It's true. So everyone loves a good origin story. You've shown us the construction of the McClellan oscillator, which you mentioned your parents, Sherman and Marion McClellan, had created. Can you tell us about how the McClellan oscillator became popular? How did people learn about this? And you and I, when we met last, had a great story about just the TV coverage of the McClellan oscillator. Can you share that with the audience?
Sure. Well, my dad was long interested in the stock market. And he was frustrated that he didn't have good tools like we have now. If you wanted to have charts, you either had to subscribe to a charting service or you had to get some graph paper and plot them yourself. He was a subscriber to a newsletter called the Trade Levels Report back in the 1960s, which was published by a guy named Pete Harlan. Pete Harlan got into the newsletter business as a sideline from his actual job as a rocket scientist at Jet Propulsion Lab. And so he was the first guy, at least west of the Mississippi, to ever use a computer to do technical analysis because he had access to one. So he'd do his daytime job doing rocket science stuff, plotting the trajectories of rockets and satellites. He was part of the whole idea behind sending the Voyager probe out to the outer reaches of the solar system by using the gravitational pull of Jupiter to help propel it back out there. So he was a super smart guy, and he was aware of the invention in the 1950s of the math behind exponential moving averages. And they used that math to program the analog circuitry in the guidance systems for the rockets, because it's very simple math. All you need to know is what is the current data point and what is yesterday's or the prior value of the exponential moving average. If you think about a simple moving average, 50 days or 200 days. You got to keep track of 50 numbers or 200 numbers and then calculate the average of all those. The exponential moving average is mathematically much more simple, and it's much more responsive. And so Pete Harlan was using these exponential moving averages, which he called these trend values, and he used the percentage of the smoothing constant as the name for each of these trend values, and we've maintained that. But he was writing about them in his trade levels report. So my dad wanted to know more about this and wanted to be able to understand it himself. And so my mother was a mathematician back in the days when that was not fashionable for young ladies to do that, but she was wicked smart, and so she was able to help him. They got out some ledger paper and some graph paper, and they started keeping track of the daily breadth numbers and plotting these exponential moving averages that Pete Harlan looked at. And the key insight that they had was, well, what about the difference between two moving averages? And so they initially called that the 10-5 oscillator because it was the difference between the 10% trend and the 5% trend. Well, there was a guy on TV in Los Angeles where they lived, and my dad still lives there. My dad is 90, by the way, still doing great, still working with me. There was a guy named Gene Morgan who had a TV show on KWHY, this little UHF station that was the original business channel before CNBC, before FNN, before anything else. KWHY did business coverage during the day, and at the end of the day, in fact, they invented the scrolling ticker at the bottom of the screen. So Gene Morgan had this show that he did, a TV show on this UHF station called Charting the Market. And in the late 1969, he put out an announcement on the air, said, hey, if anybody's got an interesting chart, let him know. Maybe he'll put it on the air. And so my dad called him up and said, I got something you might be interested in. And it was what Gene Morgan then named the McClellan Oscillator. And it became very popular on Gene's show when my dad went on the show and introduced it to Gene's viewers. And in fact, that's how it became known to the world, is through people watching KWHY TV in Los Angeles and finding out about what Gene called the McClellan Oscillator.
That's such a great story, Tom. I'm so glad that you were able to share this with all of us. And I feel like the more that I've talked to people like you and learned about it, the more you realize that sort of the modern business coverage, financial media coverage, really, I mean, in a lot of ways started with the Bay Area, with Southern California, and some of those channels that really covered the market so beautifully, right? So that's awesome. I mean, what a cool story. I'd love to then transition to the Tom McClellan origin story. Someone once told me, pilots make great investors. Would you agree or not with that assessment?
Well, pilots do think differently. I was an Army helicopter pilot for 11 years. I studied aerospace engineering at West Point and loved. The first time I got into a helicopter for basically a training ride, I said, I got to do this for a living. But pilots are different, and pilots make for great chartists, at least. Whether they're good investors depends on other factors. But pilots and musicians and doctors are all accustomed to taking in visual information and then making a decision based on it. Like, are the wings level, or am I about to run out of gas? That's you have a gauge that tells you that. And I need to make a decision right now. Other people do not tend to think as visually, and so they're not as comfortable taking in visual information and deciding what to do. But pilots and a musician has to know when to come in on the down note and what note to play. A very similar idea. You have to take in the visual information from the sheet music and make a decision, take an action. And so being a pilot lends itself, as you know, to accepting charts and the information that they have. I got my start while I was still in the Army. I was a captain on flight pay, and I had more money than I absolutely needed. And so I thought, well, I should figure out what to do about this. So I turned to my parents, who had a little bit of background in the stock market. And my dad sent me a copy of Edwards and McGee's book, Technical Analysis of Stock Trends. And I read it from beginning to end. And this is a 3-inch thick book. And it was interesting. And I tell people, if you're thinking about becoming a technical analyst, go get that book and see if you can make it to the end. Because if you cannot make it to the end, then charting is not for you. But if you cannot put it down, then yeah, okay, you can do this. And it was fascinating. And so my time in the Army ended in 1993 when the Army was downsizing. We weren't ever going to have wars anymore, so we didn't need this big army. Let's let everyone go. And so I was part of the peace dividend getting out in the 90s. And I decided I wanted to pursue this. because my dad had made me aware of other newsletter writers, and you could do this for a living, write about the stock market. And so that's what I decided to pursue, and been happy doing it ever since. It's going to be 30 years in April that we've been doing this. I have a great job. I get to work with my dad and learn from him, and he gets to learn from me and get to find fun insights about what the market's going to do.
Tom, I feel like so many investors are better off because of that decision that you made a couple of years ago, getting into this part of the industry, and again continuing the work of your parents. That's just exceptional and unique, and I think worthy of a celebration for sure. You have one more chart with the time we have remaining that I want to get to. We talked a little bit about comparing where we're at now to some historical periods, and you actually have a really interesting analog to talk through. Share with us what this is telling you about, where we're at relative to where we've been.
Sure. Well, this is comparing the current period to the 1980 election when Jimmy Carter lost re-election and President Reagan won. And I need to define a little bit what we mean by a patterned analog. Sometimes patterns appear that look similar to other patterns, and so chartists will say, "Oh, look at this! It's exactly like this other time," but then that eventually breaks up. You get a stickier analog when you have basis conditions, some fundamental factors that are very similar. And so this chart aligns the current period with the 1978 to 80 period on a calendar day basis. And what we're really taking advantage of is the similarity in the market's behavior over the course of a 4-year presidential cycle. When Reagan got elected in 1980, his election was anticipated and celebrated. And oh my gosh, everything's going to be better. He's going to be a transformative president. He's going to solve all our problems. He's going to make everything better. And so they bid the market up. There's been that same sort of feeling this year that Trump is going to come in. He's going to solve all our problems. We're not going to have a deficit anymore. He's going to deregulate everything. It's all going to be wonderful. The problem is that when you have that expectation get overdone, then you set up the market and the stock market for disappointment. And when January 21st rolls around and the guy's been in office for a whole day and he hasn't solved all our problems, then we start looking at our navel again and thinking, oh, look at all these problems, and Congress is arguing and he can't get this done, he can't get his people in. And so reality has a way of setting in hard. Well, what's interesting about that 1980 period, we had a big spike top in late November, and then there was a very sharp drop to a bottom on December 11th. Now, the drop this time came to a bottom on December 19th, so not exactly perfect on a calendar day basis, but the dance steps are still matching up pretty nicely. And so if the dance steps continue matching nicely, which is always the question, we should get a really robust rebound as the bungee cords snap the market back up higher. And it may be a failing rally. It may be some new rally if the Fed decides to throw more money and liquidity at the system. We don't know, but for now, we're still matching the dance steps of 1980. And that's a problem because 1981 was not a great year. And it continued to not be a great time all the way till about August of 1982 when we got a really hard bottom, a famous bottom. And then all the reforms that were happening to the system finally took effect and started working. And we finally had Volcker letting off the brakes with high interest rates trying to fight inflation. So, but getting to that moment of transition was a long, hard period. I think we're going to be in for that in 2025 because the problems that Trump and his team are going to be facing, they're big problems. They're not something that you can just flip a switch and get solved. And so long, lengthy, difficult problems take a long time to get through. And I think that's what we're facing ahead. But there's no guarantee. And we're going to be continuing to watch that pattern in our newsletter and our daily edition as time goes forward to make sure it still follows the script.
It's such a great chart, and I'm so glad you shared that, Tom. And it's so funny. I feel like when you think about something like the Reagan presidency, 8 years, we usually think of the other 6 years, which were this incredible, one of the greatest bull markets in U.S. history, leading into the 90s, which was even better. First couple of years were kind of rough, as you reminded us from that first chart. So the most important question I have to ask, if that is what could be in store, what are you thinking now? Is your general approach at this point to sort of stick with trends as long as they work, And if so, what would tell you that the conditions really are starting to deteriorate in a way that maybe that historical analog would imply? Like, what would tell you that the conditions are really deteriorating?
Yes, of course, following trends is the important thing to do. And it's a really hard thing to do because I'm a trader and I want to trade. And it's really hard to sit on my hands and not doing anything. But when you see breadth breaking down, and we really are seeing breadth looking uglier. We didn't get the AD line divergence for the New York Stock Exchange AD line, but high yield bonds trade like stocks, and their advanced decline line is showing us a divergence. So we are seeing some signs of trouble, and we've gotten another cut from the Fed, which is great, and that's helpful because they were too high. I don't know what they have up their sleeve coming forward, but there's going to be some other problems if we ever do get Congress committed to doing something about the debt and the deficit. That's going to be bearish because deficit spending is an extremely bullish factor. When you're running up the credit card, life is good. When you're paying off the credit card, you're eating peanut butter sandwiches and beans, and it's not so fun. And so if Congress can ever succeed at doing something about that, that's not bullish. It's important and it should be done, but it's not bullish. So 2025, there are times to be a buy and hold investor. 2025 is not one of those times. Market timing has its place, and you're going to have a much better opportunity to buy low and sell high, rinse and repeat over and over in 2025.
This has been awesome, Tom. I'm so glad we were able to share some of these great stories and some really interesting charts, sort of putting 2024 into context, setting us up for the year to come. Where can we point people to learn more about you, the McClellan Market Report, and the things that you're working on now?
Well, you can follow me on Twitter. My Twitter handle's up there on the screen. You can visit our website, mcoscillator.com. That's just a contraction of the McClellan Oscillator. You can sign up for our free weekly chart and focus, no strings attached. We won't sell your address to anybody. If you want the good stuff, we have a twice monthly newsletter called the McClellan Market Report. It's finishing its 30th year, and we're still going. We also have a daily edition, comes out every day the market trades. You can see samples of that and sign up if you decided it would be interesting to you.
This has been a pleasure, Tom. As always, great to see you again. Have a fantastic holiday, and I hope we can catch up again in the new year, all right?
Have a Merry Christmas.
What a fun conversation with Tom McClellan. I met Tom for breakfast earlier this year, and we talked about coming on the podcast once I'd had it launched, and I'm so excited I was able to sit down with him here. I've known Tom for a number of years. He actually first invited me to Seattle years ago to speak to the MTA Puget Sound chapter, now the CMT Association. That was my first visit to the Seattle area, and I remember flying into this area and kind of knowing that it was a special place for me. I didn't realize that it would mean that later in my life I would move my family out to Redmond, Washington, and become a resident here. But it was really a fun introduction there. So I can't thank Tom enough for introducing me to this beautiful region of the country and becoming really a friend over the years as we've gotten to know each other. And I've certainly followed and respected Tom's work for quite some time. Tom had shared me that story about his parents and creating the McClellan Oscillator, and about TV in Southern California, the LA area, and how that all happened. I'm just so glad he was able to share that story with all of you. I thought that was really, really interesting. It really gets to the essence of what technical analysis offers, right? I mean, from those kind of humble beginnings with a small audience in Southern California, it's really proliferated to be something that so many individual investors rely on, and particularly the McClellan Oscillator. But I think it really shows you the benefits of technical analysis, which from its beginnings has been to empower individual investors, to empower smaller investors to have a seat at the table, have the opportunity to compete with money managers, compete with Wall Street at their own game by having a window into supply and demand, into fear and greed. And I thought, as Tom explained the origins of the McClellan Oscillator, the mechanics of it, and why it was designed in a certain way, and then applying it to the current market, also to some historical market comparisons, I thought was just really brilliant. And I can't thank Tom enough for giving us some time and sharing his expertise with all of us. Would love to know, by the way, if there are others that I should sit down with. This is our final podcast episode of 2024. We already have some really fun interviews set up for January of 2025, and I would love to know who else we should interview for the Market Misbehavior podcast. Wherever you're listening to this, please make sure you leave a comment and let me know who we should connect with. I'm happy to approach anyone you think would provide a great conversation for us. Can't tell you how much I appreciate you sharing the Market Misbehavior podcast with others. If you know people that are investing, that are looking to understand the markets a little better, improve their market awareness, thanks for sharing this with them. I would love to get more and more people appreciating the benefits of technical analysis and behavioral finance. And by the way, if you are ready to take maybe making a renewed commitment to better decision making and more mindful investing in the year and the years to come, maybe our premium memberships at Market Misbehavior could be a good choice for you. 3 real benefits of the Market Misbehavior premium membership. Number 1, virtual courses. We have a course called Flight School Behavioral Investing. We really break down a lot of the concepts that we tease out during the Market Misbehavior podcast, just how to understand the markets using technical analysis, how to understand what's happening in our own brains as investors using what's called behavioral finance, and giving you a set of tools and techniques to improve your situational awareness as an investor. We also do some premium members only report. Our core report's called the Weekly Flight Plan that goes out every weekend, where we focus on lessons learned in the week that just happened and looking forward at signals and patterns to pay attention to in the week to come. We also do a monthly chart review where we apply our proprietary market trend model to a bunch of different charts and then share conclusions and key takeaways. Finally, we have an active members-only community. We're able to ask questions. You're able to observe what questions other premium members, people trying to answer the similar questions to you, people trying to invest and grow their own portfolios. You'll see what they're running into, see some of my answers as well, and share some great market updates at the same time. If you're interested in all of those things and want to improve your commitment or renew your commitment to making more mindful investing decisions, go to marketmisbehavior.com/premium. Don't forget to use the code podcast when you check out for 30% off your first 12 months on any plan. Again, that's marketmisbehavior.com/premium. That's it for now. And that's it for 2024. Thank you so much. It's been a fun experience launching this new podcast. We're so excited about what we will do in the weeks and months and years to come. And I appreciate you coming on this journey with me. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts.